What's up, everyone? It's December 22nd, 2025. This is your host, Wang, back with another data-driven market breakdown. Today, let's start with a staggering number, negative $158 million. Bitcoin spot ETF flow data showing a negative 158 million net outflow for the previous Friday. That's right. As the market closed last Friday, the Bitcoin spot ETFs we track saw a massive single-day net outflow of $158 million. At this critical juncture, as Bitcoin challenges the historic $90,000 mark, Wall Street's smart money isn't doubling down. Instead, they're pulling back on a massive scale. Is this a strategic, temporary retreat, or is it the most dangerous signal of a bull market top? Can we actually break through this $90,000 wall? Today, we're going to combine a macro analysis of fund flows with the micro principles of Wyckoff theory to give you a deep dive analysis of this incredibly pivotal market moment. Buckle up, the alpha is coming right up. All right, let's get straight to it. My core thesis is this: the market is facing a severe test at the $90,000 key resistance level. A failure to achieve a decisive breakout would be a strong bearish signal, and long positions should consider exiting. This isn't a guess. It's a conclusion derived layer by layer from the 9 data dimensions in today's report. Let's break them down one by one. Part 1. Macro trend and technical structure. Signs of distribution. First, let's look at this weekly chart for Bitcoin. Bitcoin weekly chart with 20-week and 60-week moving averages highlighted. We can see that after last week's close, the price did bounce from the trend line near $89,000, but this was not a strong V-shaped recovery. More importantly, I want you to focus on these two lines on the screen, the 20-week and 60-week moving averages. They are forming a very clear crossover. In technical analysis, this is a classic signal of a pending price correction, indicating a very high probability of a pullback from this $90,000 level. From a Wyckoff analysis perspective, the current price action below $90,000, characterized by a failure to gain traction and repeated failed tests of resistance, perfectly fits the profile of a typical distribution phase. This means that early institutional capital may be exploiting the market's final waves of greed to quietly offload their bags in batches to late-stage retail investors chasing the highs. Part 2. On-chain liquidity and whale activity, the invisible sell wall. If technical indicators are the market's facial expression, then on-chain data and the order book are its heartbeat. They show us where the real money is moving. Now, look at this liquidity heat map. Liquidity heat map showing a large concentration of sell orders at the $90,000 price level. The darker the color, the larger the resting orders. You can clearly see a massive amount of sell orders stacked at the $90,000 price level, forming a visible sell wall. What does this tell us? It tells us that a significant number of institutions or whales are heavily defending this level. Their message is clear: if the price gets here, we are selling. This thesis is further corroborated by large order flow data. We've observed many large protective bids being pulled recently. Concurrently, our intel suggests that the $90,000 mark is a key take-profit zone for many large institutional short positions. When you connect these dots, the picture becomes crystal clear. The big players are not bullish on a breakout above $90,000. They are positioning themselves for a potential correction. Part 3. Market sentiment and fund flows. The fear and greed mismatch. So, while institutions are preparing to exit, what's the sentiment among retail traders? Let's look at the Fear and Greed Index, which you're all familiar with. It's currently at 29, in a state of fear. While this is a slight improvement from the extreme fear of a few days ago, there is a very alarming mismatch here. Typically, when prices are at highs, market sentiment should be greedy. When prices are low, sentiment is fearful. Right now, the price is still hovering near its all-time high of $90,000, yet the sentiment is already fearful. This suggests that the market's fear hasn't been fully priced in, or in other words, the current price does not accurately reflect the market's fragile psyche. If the price breaks a key support level, this suppressed fear could be unleashed instantly, triggering a cascade of liquidations. Now, let's examine on-chain fund flows. Over the past 24 hours, we've seen a significant net inflow to exchanges. Many might interpret this as dip buyers stepping in. However, at this critical resistance level, I lean towards a different explanation, one that is a common phenomenon in a Wyckoff distribution phase. This is long-term holders moving their Bitcoin from cold storage onto exchanges, gearing up to sell. This represents massive potential sell-side pressure, not healthy buy-side demand. Finally, let's circle back to the ETF data from the intro. Last Friday's $158 million net outflow is the most direct signal of macro capital's stance. In the face of $90,000, the giants of traditional finance chose to take profits off the table. As the market opens this Monday, ETF fund flow will be the #1 indicator we need to watch like a hawk. It will provide the most immediate directional cue for the market. Alright, to synthesize all these data dimensions, from the weekly technical structure and the microstructure of the order book to market sentiment and macro ETF flows, all the evidence points to one highly consistent conclusion. $90,000 is an extremely strong resistance level, and at this stage, the downside risk far outweighs the potential reward of an upward breakout. So, based on this analysis, how should we formulate our trading strategy? I'll use a combination of the MACD and ATR, average true range, indicators to give you two clear recommendations. For investors already holding long positions, although the weekly MACD slope is still positive, its momentum is clearly waning, indicating the uptrend is showing signs of exhaustion. I strongly recommend setting your take profit or protective stop loss just below $90,000, for instance at $89,500. If the price repeatedly fails to break $90,000 and shows signs of weakness, you should exit decisively to lock in the hard-earned profits from this bull run. Don't trade on hope, respect the data. For traders looking for new opportunities, the ATR indicator shows that market volatility is compressing, and the $90,000 level coincides with the ATR's overbought threshold. This means the current slow corrective price action is highly unsuitable for opening new longs. Conversely, for traders with a higher risk tolerance, you could consider building a small short position, using the formidable $90,000 resistance as your anchor. Your first price target could be the psychological support zone around $80,000. But please remember, you must set a tight stop loss. For example, if the price achieves a convincing close above $91,000, you must exit the position. At a potential trend inflection point, risk management is always priority #1. To recap, today's market analysis tells us not to be mesmerized by the high price level. Beneath the surface, the undercurrents are shifting. In my view, in this battle between bulls and bears at $90,000, the odds favor the bears. This is not just a battle over price, but a battle of conviction that will likely determine the market's direction for the coming weeks, or even months. Going forward, we will continue to track ETF flows and on-chain whale activity. If you want to get our in-depth analysis first, make sure to subscribe to my channel and hit that notification bell. I also welcome you to leave your thoughts in the comments below. Do you think Bitcoin will successfully break $90,000 this time? Why or why not? Alright, that's a wrap for today. This is Wang, and I'll see you in the next video.